In 2008, families across America were packing their lives into cardboard because the house they had been told was safe had become a trap. On Wall Street, men in suits walked out of Lehman Brothers carrying the same kind of boxes. The building was still there. The company was not. Screens turned red. Retirement accounts shrank. Banks stopped trusting other banks. And people who had never heard the word derivative learned that something invisible could still reach their kitchen table. AIG needed a rescue so large it sounded unreal. Merrill Lynch was sold in a panic. Goldman Sachs asked to become the kind of institution it had spent years pretending it did not need to be. A regulated bank. This was not a hurricane. It was not bad luck. And it was not one reckless trader pressing the wrong button. The crash came from a faith that had been protected for decades inside the most respectable rooms in America. His name was Alan Greenspan, and the ruined mortgages were not even the strangest part of what he left behind. One version of Greenspan is familiar, the Maestro, the quiet central banker who seemed to keep America prosperous with a few careful sentences and a pair of glasses low on his nose. There is another version, an old man in Congress admitting that he had found a flaw in the model he had trusted for most of his adult life. But the flaw did not begin in 2008. It began much earlier, in rooms where markets were not just described as useful, but treated almost as moral truth. Before he was the priest of American money, Greenspan sat in the circle around Ayn Rand, where government interference was treated like a disease and selfishness could be dressed up as virtue. Years later, when Brooksley Born warned that a dark derivatives market was growing beyond anyone's control, the system did not stop. It closed ranks. Greenspan, Rubin, and Summers treated the warning as the danger. Then the door was locked open by law. The market that might have been watched was allowed to grow in the dark. Ordinary houses became raw material. Mortgages became securities. Securities became bets. Bets became insurance on other bets, until the machine was so complicated that the men praising it could barely explain where the danger was hiding. Then Bear Stearns cracked. Then Lehman fell. And far from the conference rooms, the punishment arrived as missed payments, sheriff notices, empty bedrooms, and keys left on kitchen counters. So when Greenspan said he had found a flaw, he was not confessing to a typo in an equation. He was confessing to the collapse of an entire worldview. That is why this story is not about one banker, one bubble, or one bad year. It is about how a calm voice can make a dangerous idea sound responsible for so long that even its victims learn to call it common sense. But to understand why he believed so completely in the system that broke, you cannot begin at the hearing table. You have to begin with a boy in New York who learned rhythm before power, numbers before politics, and certainty before doubt. Part 1. The Boy Who Learned Certainty. Greenspan was born in New York City in 1926 in a neighborhood that did not look like the marble rooms he would one day command. He came up in Washington Heights, a child of apartments, school corridors, subway noise, and a city that taught people early that every inch had a price. The first thing he wanted to master was not money. It was sound. Clarinet, saxophone, the discipline of breath and timing, the strange mathematics of a band that only works when everyone counts correctly. As a young man, he played in Henry Jerome's orchestra, a working musician in a world where glamour ended the moment the lights came up and someone had to settle the books. That is the detail worth holding. Between the music stands and the late-night travel, he was the one drawn toward the ledgers. Other musicians heard melody. Greenspan heard structure. A song had a key, a tempo, a hidden architecture. So did money. He went to New York University and studied economics with the intensity of someone who had found a second instrument. Economics for him was not yet ideology. It was a language of patterns, a way to turn the confusion of daily life into tables, ratios, and forecasts. After college, he worked as an analyst, the kind of job that rewards a person for believing that if enough numbers are gathered, uncertainty can be disciplined. This is where the first version of Greenspan begins to take shape. Not the public oracle, not the old man before Congress, a private technician of certainty. He was reserved, almost severe, the kind of man people later remembered as dry, brilliant, and not especially interested in theatrical warmth. But dryness can become power in a certain kind of room. If everyone else is nervous, the man who speaks slowly and sounds certain begins to look like the adult. In 1955, he founded Townsend Greenspan, an economic consulting firm that sold something more valuable than advice. It sold prediction. Corporate clients wanted to know what came next. Inflation, production, consumer demand, inventories, wages, the future itself folded into a report and delivered in a calm voice. That was his early gift. He made uncertainty sound manageable. And in a century increasingly run by numbers, that gift was almost indistinguishable from authority. Then, in New York, he entered a room that changed the meaning of the numbers. The room belonged, intellectually if not always literally, to Ayn Rand. Rand was not offering a technical theory of interest rates. She was offering a moral universe. In that universe, the entrepreneur was not merely useful. He was heroic. The market was not merely efficient. It was virtuous. The little circle around her called itself, with perfect irony, the collective. Greenspan was there, quiet, watchful, dark-suited, absorbed into a group that believed it was defending the individual against the world. This is the crucial thing to grasp. Greenspan did not simply learn that markets worked. He learned to see interference with markets as a kind of moral trespass. In the 1960s, he wrote in defense of gold and economic freedom, arguing in the language of Rand's world that deficit spending, welfare states, and inflation were not just policy errors. They were violations of reality. That sounds abstract. It was not. It became the private architecture through which he would later judge the entire financial system. When Greenspan became chairman of the Council of Economic Advisers under President Gerald Ford, Rand stood nearby. It was an almost too perfect image. The novelist of heroic capitalism watching her quiet disciple enter the machinery of the American state. The country he entered was not calm. The 1970s were a decade of inflation, oil shocks, wage anxiety, and a public that no longer trusted the old economic promises. For a man like Greenspan, the lesson seemed obvious. Government was clumsy, politicians were short-sighted, the market, for all its cruelty, at least had the dignity of consequence. He did not yet control American money, but he was learning the geography of power, how to speak to presidents, how to reassure business, how to sound technical when the argument underneath was philosophical. By the time Ronald Reagan entered the White House, Greenspan was no longer merely an economist from New York. He was part of the conservative economic establishment that believed the old restraints had gone too far. And then came the call that would turn a consultant into one of the most powerful men on earth. But before that call, before the Fed, before the marble building, and the congressional testimony, there is one more thing to understand about the Rand years. They did not simply give Greenspan opinions, they gave him a cast of mind. The people in Rand's circle were not having casual political conversations of the sort people forget by Monday morning. They were building a moral vocabulary. In that vocabulary, compromise was often weakness, altruism was suspect, and the productive individual was forever threatened by the parasite, the planner, the committee, the man with a form in his hand. Greenspan was never the loudest figure in that world. That is part of what makes him interesting. He was not Rand on a stage, throwing thunderbolts. He listened. He absorbed. He translated. When he wrote about gold and economic freedom, he did it with a severity that now feels like a clue left near the beginning of a mystery. Inflation, in this view, was not just a rise in prices. It was a hidden confiscation, a way for government to take without appearing to take. Deficit spending was not simply bad arithmetic. It was moral evasion, politicians promising benefits while passing the cost into the future. This mattered because Greenspan's later moderation could hide the radical root. By the time he became famous, he did not sound like a Randian pamphlet. He sounded like a central banker, which is to say, he sounded like caution had been dressed in a gray suit. But an idea does not need to shout to survive. Sometimes it survives better when it learns to whisper in technical language. That is why the image of Ayn Rand at his 1974 swearing-in matters. It was not policy analysis. It was lineage. The young consultant had entered the formal state, but the suspicion of the state had entered with him. The 1970s then gave him the perfect evidence. Inflation made government look weak. Gas lines made planning look foolish. Stagflation made old Keynesian confidence look tired. If you already believed intervention distorted reality, the decade seemed to agree with you. Then Paul Volcker crushed inflation with brutal interest rates, proving that monetary discipline could do what speeches could not. But discipline had victims. Factories closed, borrowers suffered, farmers protested, and unemployment rose. Greenspan watched all of this as a man who believed pain could be information. That is a cold sentence. But central banking is full of cold sentences because it often turns human distress into indicators. Inflation, unemployment, output, productivity, credit spreads. The language itself creates distance. And distance was one of Greenspan's great strengths. It would also become one of his great dangers. In August 1987, Alan Greenspan became chairman of the Federal Reserve. The building did not look like a battlefield. It looked like what power often looks like when it is most comfortable: stone, columns, flags, polished floors, and doors that close softly behind you. He was succeeding Paul Volcker, the giant who had broken inflation by making money painfully expensive. Volcker had been blunt, physically imposing, almost architectural. Greenspan was smaller, quieter, more elliptical. He did not dominate a room by filling it. He dominated by making people lean in. And then, barely 2 months after he took the job, the floor fell out. Part 2. Black Monday, the First Rescue. Every powerful career has a first test that becomes a myth if the person survives it. For Greenspan, the test arrived almost immediately. He had barely settled into the chair before the market delivered the kind of event that makes theory feel decorative. Numbers fell faster than language could keep up. Inside the Federal Reserve, the problem was not only that prices were falling. The problem was that the plumbing might seize. If brokers could not fund positions, if banks pulled back, if fear hardened into refusal, a stock market crash could become something larger and more dangerous. So Greenspan's Fed sent the system a message. It did not promise every investor would be saved. It promised the machinery would not be abandoned while it was screaming. The central bank was watching. That is where the contradiction begins to matter. The man shaped by faith in self-correcting markets became credible because he intervened when markets threatened to correct too violently. On October 19, 1987, the stock market suffered one of the worst single-day collapses in modern financial history. The images from that day still have a particular electricity. Traders with phones pressed to their heads, paper everywhere, eyes fixed on boards that seemed to be announcing the end of order itself. Greenspan was new, too new, in theory, to have built the kind of authority a crisis demands. But crises do not wait for a resume to ripen. The next morning, the Fed issued a short statement affirming its readiness to serve as a source of liquidity to support the economic and financial system. Behind the words was a message to the banks. Keep lending, keep the pipes open, do not let market panic become institutional death. It worked, or at least it seemed to. The crash did not become a second Great Depression. The financial system did not dissolve. The new chairman looked steady. This is where the legend begins. Not because Greenspan created the crash, and not because he solved every problem that caused it, because he learned the first intoxicating lesson of crisis management. If the market falls hard enough, the central bank can put a floor under it. Later, people would call this the Greenspan put. The phrase was not a formal policy. It was more dangerous than that. It was an expectation. Investors began to believe that if markets panicked badly enough, the Fed would arrive. That belief did not make every investor reckless overnight. History is rarely that clean. But it did begin to change the emotional weather of American finance. Risk started to feel insured by someone else's calm. For Greenspan, the 1987 rescue confirmed something flattering. Markets might be chaotic, but a sufficiently wise technocrat could calm them without directly commanding them. Presidents came and went. Reagan gave way to George H.W. Bush. Bush gave way to Bill Clinton. Greenspan remained. That continuity mattered. In a political system addicted to turnover, Greenspan became something rarer, a permanent man. He was not elected. He commanded no army. He gave no great campaign speeches. But with a few sentences, he could move the price of money for the entire world. And in the 1990s, the world began to treat that as a kind of magic. Part 3. The Maestro. By the 1990s, Greenspan had become something stranger than a regulator. He became an event. When he spoke, traders watched screens with the intensity usually reserved for battlefield reports. When he refused clarity, the refusal itself became information. Economists parsed adjectives. Reporters weighed pauses. Bond desks tried to turn his fog into trades. This was not accidental. Greenspan understood the power of ambiguity. A central banker who speaks too plainly can move markets before policy is ready. A central banker who speaks too carelessly can create the very panic he wants to avoid. So Greenspan cultivated a language that sounded precise while leaving room to escape. It made him look almost priestly. Presidents listened. Senators deferred. Bankers adjusted their posture when he entered the conversation. And the more people treated him as indispensable, the more indispensable he appeared. There is a strange moment in the life of powerful men when criticism stops sounding like criticism and starts sounding like proof of importance. By the middle of the 1990s, Alan Greenspan had reached that moment. If he spoke clearly, markets reacted. If he spoke obscurely, markets reacted harder. Traders parsed his sentences for hidden meaning, as if the future of interest rates were tucked between subordinate clauses. He became famous for a style of language that seemed designed to say something and erase it at the same time. That was not a weakness. It was part of the instrument. People joked about Fed speak, the deliberately dense dialect of central bankers. Greenspan became its most famous practitioner. He once joked that if he seemed unduly clear, people must have misunderstood what he said. The joke worked because everyone knew it contained a truth. Ambiguity was not merely evasion, it was a way to move through a world where one misplaced sentence could erase billions of dollars before lunch. This is one of the oddities of modern money. It depends on confidence, and confidence depends on language, and language depends on people pretending not to be frightened by how much depends on language. In 1994, the bond market learned that lesson sharply when the Fed raised rates, and investors who had grown comfortable suddenly discovered that comfort is not a contract. The so-called bond market massacre did not destroy Greenspan's reputation. It refined it. He was no longer just the man who calmed markets. He was the man markets had to fear in order to trust. By the end of the decade, Bob Woodward could title a book about him Maestro, and the title did not sound ridiculous to Washington. Think about what that means. A democratic republic had become comfortable describing an unelected central banker with the language of musical genius. A maestro does not merely participate, he conducts. Senators who disagreed on almost everything treated him with a kind of bipartisan deference that now feels almost impossible. He would arrive with a thick statement, read in a low voice, answer questions with mathematical fog, and leave behind a room full of people who felt they had been near seriousness. Newspapers covered his smallest shifts in tone. Cable television built segments around hints. Traders built positions around what they thought he had meant. This was not only celebrity, it was structural dependence. The more markets trusted Greenspan, the more Greenspan's presence became part of the market itself. And that created a loop. Markets rose, proving the maestro was wise. The maestro's reputation grew, reassuring markets. The reassurance helped markets rise. No one had to plan it. The loop planned itself. The Clinton years gave him the perfect stage. Low inflation, rising productivity, a booming stock market, the internet turning from a curiosity into a fever. Money was moving faster than language could catch it. Companies with no profits became fortunes. The word future became a business model. In December 1996, Greenspan gave the speech that should have made people pause. He wondered aloud how one knew when irrational exuberance had unduly escalated asset values. Markets around the world shuddered. That is how powerful the man had become. A phrase in Washington could travel overnight into Asian trading screens. But the warning did not become a doctrine of restraint. It became another part of the performance. Greenspan saw excess, but he also believed something deeper, that central bankers were bad at identifying bubbles in real time, and even worse at safely deflating them before they burst. So the posture became almost elegant in its danger. Do not prick the bubble. Clean up after it. There is logic in that. It sounds prudent. It avoids panic, avoids overreach, avoids the arrogance of pretending to see perfectly through fog. But look at the incentive it created. If markets believed the Fed would not stop the party on the way up and would help sweep glass from the floor on the way down, the party changed. The room got louder. By 1999, Time magazine put Greenspan on the cover with Robert Rubin and Larry Summers under a phrase that now reads less like praise than evidence. The Committee to Save the World. Pause on that for a moment. Three men, none of them elected president, presented as the sober guardians of global capitalism. Rubin had come from Goldman Sachs to the Treasury Department. Summers had the confidence of a man who had rarely been told he was the least intelligent person in any room. And Greenspan, older and quieter, supplied the mythic center, the technician above politics, the philosopher of markets who somehow also ran the price of money. This is how power hides in plain sight. It does not always wear a uniform. Sometimes it wears a suit, speaks in footnotes, and gets called prudent by people who are making fortunes from the prudence. The late 1990s offered warning after warning. Asian markets convulsed. Russia defaulted. Capital moved with a violence that made national borders look sentimental. Then came long-term capital management. LTCM was supposed to be what happens when genius is allowed to compound. It had elite traders, Nobel-level financial minds, and models that promised to turn small pricing differences into enormous, nearly riskless profits. Nearly riskless. Those are the two words financial history keeps tripping over. When the world moved in ways the models had not expected, the fund's positions threatened to spill through the financial system. The Federal Reserve Bank of New York helped bring Wall Street banks together for a private rescue. Technically, taxpayer money did not bail out LTCM. That detail matters. But psychologically, the message mattered more. When enough leverage threatened enough important institutions, the system would gather in a room and find a way. Greenspan saw the danger. He was not stupid, and he was not blind. That is what makes the story more interesting than a simple morality play. He could see risk. He could describe risk. He could even warn about risk. What he resisted was the idea that government should cage the market before the market had proven it deserved a cage. And that is where Brooksley Born enters the story. Part 4. The Woman Who Saw the Dark Market. Every empire has a moment when someone inside the room says the quiet part early. Not loudly enough to stop the machine, not powerfully enough to rewrite the outcome, but clearly enough that history can later point to the sentence and say, "There, that was the warning." Brooksley Born did not look like a revolutionary. She looked like what she was, a careful lawyer, precise, restrained, interested in what contracts actually said and what markets actually did when nobody glamorous was watching. That made her dangerous to a culture intoxicated by financial elegance, because the question she asked was simple enough to embarrass the experts. If this market is so enormous, so connected, and so capable of transmitting losses across institutions, why is so much of it hidden from view? To Greenspan, Rubin, Summers, and other guardians of the era, the question sounded less like prudence than interference. They worried that even asking too loudly could destabilize the market. That is one of power's oldest defenses. The machine is too delicate to inspect. But inspection is not the same as destruction. Sometimes inspection is the last chance to understand what destruction would look like before it arrives. Greenspan's resistance mattered because he had unmatched credibility. When he opposed scrutiny, he did not sound like a banker protecting profit. He sounded like expertise protecting stability. That is why the warning could be contained. Every good tragedy has a character who sees the shape of the danger before the people with power are ready to admit the danger has a shape. In this story, that character is Brooksley Born. Brooksley Born was not a revolutionary trying to burn down Wall Street. She was a lawyer, a regulator, and by temperament almost the opposite of a bomb thrower. She chaired the Commodity Futures Trading Commission, an agency whose very name sounds like it was designed to make ordinary people stop listening. That obscurity was part of the problem. The most dangerous financial changes often happen in places whose names are boring enough to protect them. Nobody riots over a concept release. Nobody cancels dinner plans because an agency asks for comment on over-the-counter derivatives. But in 1998, the question of whether to even study those markets was already explosive. Over-the-counter meant private, bilateral, away from the open exchange floor, away from ordinary price transparency, away from the kind of public architecture that lets outsiders see stress building. Traditional exchanges at least had a theater to them, bodies in a pit, hands in the air, Prices shouted where other people could hear them. The OTC world was quieter. Phones, contracts, counterparties, models, collateral calls, and a level of complexity that made accountability feel like an amateur's demand. Bourne understood that opacity itself was a form of risk. If no one can see the whole web, then no one can know which strand will pull the ceiling down. The men opposing her understood something too. They understood that markets sometimes depend on not being startled. Rubin came from the world of sophisticated finance, where speed and confidence were not luxuries. They were infrastructure. Summers believed in elite competence, and few things offend elite competence more than a regulator suggesting the room is less in control than it thinks. Greenspan brought the deepest skepticism of all, the suspicion that regulation would do more harm than the risk it tried to restrain. So the door closed. Bourne would later be remembered as prophetic, but prophecy is a title people grant after they have already ignored the prophet. And almost immediately, the system gave Washington a practical demonstration of what hidden leverage could do. But buried inside that bureaucratic world was one of the most important questions in modern finance. What happens when a vast market grows in private, between institutions, outside exchanges, outside ordinary disclosure, and outside the sightlines of the public? Bourne wanted to ask whether over-the-counter derivatives needed oversight, not ban them, not destroy them. Ask whether a market big enough to threaten the system should have rules before it threatened the system. The response from the guardians of the system was swift. Greenspan, Rubin, Summers, and Arthur Levitt opposed the CFTC's move, warning that even raising the question could create legal uncertainty and disturb the market. Read that again in plain English. The danger was not the hidden market. The danger was asking too loudly whether the hidden market was dangerous. Bourne was isolated. In Washington, isolation rarely announces itself with shouting. It arrives as meetings you are not invited to, phone calls returned too late, and serious men explaining that your caution is irresponsible. That is the second image to hold in your mind. A woman trying to pull a curtain back, and the men praised as the saviors of the world, telling her the curtain is what keeps the room stable. Greenspan's position was not mysterious. He believed sophisticated counterparties could protect themselves. Banks, hedge funds, insurers, dealers, these were not widows buying bad bonds from a boiler room. They were large institutions with lawyers, models, collateral agreements, and every reason to manage their own risk. That sounds reasonable. It was the same reasonableness that made the future catastrophe possible, because the question was never whether each firm believed it was protecting itself. The question was, what happened when all of them protected themselves in ways that made the whole system more fragile? Years later, that question would land with particular force on a unit of AIG that wrote protection on mountains of credit risk. One contract looked manageable. A web of them could become a trap. But before the trap snapped shut, Washington made a choice. Part 5. The Law That Left the Door Open. In December 2000, while most Americans were focused on a presidential election that had barely survived Florida, Congress passed the Commodity Futures Modernization Act. The law did many things, and like most consequential financial laws, it hid its importance behind language almost nobody outside the industry wanted to read. But one of its most important effects was to keep much of the over-the-counter derivatives market outside the kind of regulation Brooksley Bourne had wanted to explore. Greenspan and the other market guardians got the world they preferred. The dark market would stay mostly dark. To understand why this matters, forget the jargon for a moment. Imagine a neighborhood where every house is insured by the same company, then every insurance policy is insured by another company, Then bets are placed on whether those insurers can pay. Now imagine no one has a complete map of who owes what to whom. That, simplified but not falsely, is the kind of world credit derivatives helped create. Derivatives can serve real purposes. They can hedge risk, transfer exposure, smooth volatility, and help institutions manage uncertainty. This is where fairness matters. Greenspan was not wrong that financial innovation could be useful. He was not wrong that markets often process information faster than bureaucracies. The problem was what happened when useful tools became sacred objects. For Greenspan, the market was never merely a machine. Somewhere deep in the structure of his mind, the market still carried moral authority. That meant government intervention did not begin as a neutral option to be evaluated. It began as a suspicion. So the door stayed open, and behind it the machine became larger, faster, and harder to understand. Then the dot-com bubble burst. Part 6. Cheap Money and Expensive Houses. This is where the story stops looking like high finance and starts looking like a normal American street. Because most bubbles do not arrive wearing a warning label. They arrive as relief. A bigger kitchen, a better school district, a feeling that life is finally moving in the right direction. To a family at a mortgage desk, the global financial system did not look like a machine. It looked like a person across the table saying yes. Yes, you qualify. Yes, the house will keep rising. Yes, the low payment is real enough for now. Yes, you can refinance before the pain arrives. Behind that yes was an economy flooded with cheap credit. After the dot-com crash and the shock of September 11th, the Federal Reserve cut rates aggressively. There were real reasons for fear. There were real reasons to support demand. The economy was wounded, and central banks do not stand still while panic spreads. But emergency medicine can become a habit. The longer the liquidity stayed in the bloodstream, the more the system adapted around it. Mortgage companies built sales machines around it. Builders built neighborhoods around it. Investment banks built bond factories around it. Consumers built spending habits around it. Cheap money does not force a crisis by itself, but it changes the temperature of the room. At a certain temperature, caution starts to feel old-fashioned. The first crash of the new century did not come from houses. It came from dreams with websites attached to them. The NASDAQ collapsed, paper fortunes vanished, and the story Americans had been telling themselves about a frictionless new economy began to sound embarrassing. Then came September 11th. Financial markets closed, reopened, and moved under the shadow of a national trauma that turned ordinary uncertainty into something heavier. The Fed cut rates, then cut again. Money became cheaper, and cheap money always goes looking for a story to justify itself. In the early 2000s, the story became housing. Houses felt safer than dot-com stocks. They had walls, roofs, driveways, school districts, granite counters, and the emotional advantage of not looking like speculation. The country built. Developers poured foundations. Mortgage brokers opened offices. Families stretched for square footage they had been told would only get more expensive. In Phoenix, subdivisions pushed outward into the desert. In Las Vegas, houses rose with the speed and unreality of casino architecture. Entire neighborhoods built on the assumption that tomorrow's buyer would be more desperate than today's. In Florida, real estate signs multiplied like a second crop. In California, open houses became rituals of anxiety, families walking through kitchens they could barely afford, while being told affordability was an old-fashioned way to think. This is the emotional engine of a housing bubble. It does not run only on greed. It runs on fear of being left behind. Greed is easy to condemn. Fear is more useful to understand. A borrower who believes prices will rise forever is not necessarily irrational in the way outsiders imagine. If everyone around him is being rewarded for believing, disbelief starts to look like poverty. That was the trap. The market did not only sell loans, it sold belonging. Countrywide became one of the great engines of the age. Its chief executive, Angelo Mazzillo, with his deep tan and salesman confidence, looked like a man built by the boom he was feeding. The mortgage desk became a point of transformation. A family entered with income, anxiety, and a desire for permanence. The system turned that desire into a loan. Some loans required less documentation than prudence should have allowed. Some brokers were paid for volume, not for the long-term survival of the borrower. Teaser rates made the first years look manageable, and the later years somebody else's problem. The reset date sat in the contract like a small mechanical device. Quiet, legal, waiting. At the closing table, the whole financial system compressed into signatures. The borrower saw a house, the broker saw a commission, the lender saw a loan to sell, the bank saw raw material. Then the loan became data, then the data became a security, then the security became inventory for Wall Street. This is one of the most important transformations in the whole story. The house did not disappear exactly, but it stopped being only a house. It became a stream of payments that could be sliced, bundled, rated, insured, and sold to someone who would never meet the borrower or see the street. In that distance, something human was lost. The borrower became a cash flow. The neighborhood became collateral. The future became yield. The alchemy did not stop at mortgage-backed securities. Securities could be repackaged into collateralized debt obligations, and pieces of those could be transformed again. Each transformation created distance from the original act, a person promising to pay for a house month after month. Ratings agencies stood near the center of the machine. A stamped rating could turn suspicion into eligibility. Pension funds, insurance companies, and global investors could buy what they might otherwise have feared. Risk traveled because it had been given a passport. Then came the insurance on the risk, and the bets on the insurance, and the institutions that believed the math of default could be mastered by people smart enough to price it. This is why Brooksley Born's warning returns like a ghost. She had not needed to predict every mortgage default, every tranche, every panic. She had only needed to understand that a hidden market big enough to matter should not be hidden. And in February 2004, Alan Greenspan gave a speech that would later read like a time capsule from a vanished world. He argued, carefully and technically, that many American homeowners might be paying more than necessary by using traditional fixed-rate mortgages. Some, he suggested, could benefit from adjustable-rate mortgages if they manage the risks. Be precise here, because the cheap version of this story is too easy. Greenspan did not walk into poor neighborhoods and order families into exploding loans. He was making a technocratic argument about interest rate risk and financial choice, the kind of argument that sounds sensible in a seminar and sinister only after the water rises. But timing matters. By 2004, the mortgage industry was not a classroom. It was a machine with quotas, incentives, brokers, securitizers, and investors hungry for product. When the most respected central banker in the world spoke favorably about mortgage innovation, the industry did not hear a footnote. It heard permission. Greenspan was not unaware that housing prices were becoming strange. He spoke of froth in local markets. Froth is a remarkable word. It sounds light, temporary, almost decorative, something on top of the drink, not poison in the glass. But across the country, the signs were not light. Prices were detaching from incomes. Lending standards were bending. Houses were being bought not just to live in, but to flip before the music stopped. Greenspan did warn about some dangers. He worried about Fannie Mae and Freddie Mac. Fannie Mae was not a marginal player. It sat near the center of the American mortgage system, where private profit and public guarantee blurred into something politically powerful and financially dangerous. Freddie Mac, too, carried the aura of government support while operating inside the incentives of financial markets. On this, Greenspan was more alarmed than some of his later critics remember. He understood that the government-sponsored enterprises could become a source of systemic risk. That is the uncomfortable part. He saw pieces of the danger. He named some of them. He did not assemble the whole machine in time. The question is why? One answer goes all the way back to that New York circle around Rand. If the market is a moral intelligence, then the burden of proof falls heavily on anyone who wants to restrain it. And Greenspan had spent a lifetime believing that government officials were usually worse at allocating risk than the people taking it. But the people taking it were not always keeping it. They were originating, slicing, selling, insuring, and moving it down the line. Risk did not disappear. It became harder to see. In January 2006, Alan Greenspan left the Federal Reserve. He left as a legend, the Maestro exiting after nearly 19 years at the center of the world's financial nervous system. Ben Bernanke inherited the chair. He also inherited a housing machine already moving too fast to stop gracefully. Part 7. The machine begins to break. The first sound was not a crash. It was a missed payment. Then another. Then a reset notice opened at a kitchen table. Then a subdivision with more signs than buyers. Then a lender nobody outside the industry had heard of suddenly mattered to everyone inside it. Financial collapses often begin as local facts that powerful people can still describe as isolated. Contained was the word people wanted. Contained to subprime. Contained to bad lenders. Contained to overheated neighborhoods. Contained to people who had borrowed irresponsibly. Contained is a beautiful word when nobody has mapped the pipes. Because the danger was not only that borrowers might default, the danger was that those defaults had been sliced, renamed, insured, leveraged, and sold into places that looked unrelated until the stress arrived. When depositors lined up outside Northern Rock in Britain, the old image of a bank run returned to a world that had thought itself too modern for such scenes. Greenspan was no longer chairman by then. The emergency would be managed by other hands. But the architecture had been built during the age of the Maestro, and architecture matters most when the ground begins to move. The first cracks did not look like the end of the world. They looked like local trouble. A lender here, a development there, a few borrowers who had taken on too much. That is how systemic crises prefer to introduce themselves, not with thunder, with paperwork. In 2007, subprime lenders began to fail. Countrywide staggered. The company that had turned mortgage origination into industrial production suddenly looked less like a titan than a warning label. Foreclosures rose. Families discovered that the optimistic math they had signed at kitchen tables was not a promise. It was a timer. On Wall Street, the same loans had been repackaged into securities, whose ratings suggested stability. The ratings mattered because they laundered fear into confidence. A risky loan pool could travel through the system wearing the costume of safety. There's a kind of magic trick here. Take enough weak things, arrange them beautifully, and declare the top slice strong. Bear Stearns hedge funds collapsed in 2007, an early signal that mortgage risk had already moved far beyond the borrowers. By August, credit markets were seizing. Institutions no longer knew exactly who was holding the bad paper, because the paper had been transformed too many times. Fear moved through the system faster than facts. That same year, Greenspan published his memoir, The Age of Turbulence. He was no longer chairman, but he was still treated as the man who had understood the previous era better than almost anyone alive. And this is where history gets especially cruel. The age of turbulence was not behind him. It was just arriving. In March 2008, Bear Stearns cracked open. Part 8. The Weekend Rescues. Bear Stearns did not die slowly in public. It fell across a weekend, the way modern financial institutions often fall when everyone is trying to make Monday survivable. J.P. Morgan agreed to buy it with extraordinary support arranged around the Federal Reserve. Greenspan was out of office by then. Bernanke, Treasury Secretary Henry Paulson, and New York Fed President Timothy Geithner were the men in the hot room. But the question hanging over the room had been shaped during Greenspan's reign. How much risk had been allowed to accumulate because serious people believed serious institutions could police themselves? By September, the government took Fannie Mae and Freddie Mac into conservatorship. The warning Greenspan had once made about their size and structure was now no longer an argument. It was a rescue operation. The mortgage giants had become too important to let fail cleanly. Then came Lehman. The images were almost unbearably literal. Employees carrying boxes out of a tower, as if the crisis had been reduced to office supplies and stunned faces. Lehman filed for bankruptcy on September 15, 2008. Markets did not interpret this as discipline. They interpreted it as proof that no one knew where the floor was. Then AIG needed rescue. Here the derivative story returned with a vengeance. The invisible contracts were no longer invisible because they were elegant. They were invisible because almost no one had wanted to count them in daylight. Goldman Sachs and Morgan Stanley converted into bank holding companies, running toward the regulatory shelter that the culture of Wall Street had spent years treating as dull, old-fashioned, almost embarrassing. In a matter of days, the ideology of self-correcting markets had become a request for state protection. And far from the towers, the consequences kept moving outward. Jobs disappeared. Homes went into foreclosure. Retirement accounts shrank. People who had never heard of Brooksley-Born, LTCM, or the Commodity Futures Modernization Act were suddenly living inside the results. This is the part financial histories often compress into a statistic because statistics are easier to carry than faces. Unemployment rose, but that phrase hides the morning after the layoff, the cardboard box from the office, the drive home, the conversation at the kitchen table. Foreclosure rose, but that phrase hides the garage being open for the last time, the neighbors pretending not to watch, the school bus still coming down the same street after the child has moved away. Retirement savings fell, but that phrase hides older people recalculating the remaining years of their lives with a calculator that suddenly feels accusatory. Credit tightened, but that phrase hides small businesses unable to make payroll and owners learning that a crisis can arrive from a market they never entered. This is why the story cannot stay inside the Federal Reserve. The Fed may speak in basis points, but the consequences speak in rent, medicine, groceries, and keys handed back to a bank. So, when Greenspan sat before Congress, he was not merely defending a theory. He was facing the public wreckage of a theory that had been allowed to become infrastructure. And then Congress called the old Maestro back. Part 9. The Flaw. The hearing room on October 23, 2008, did not look like the scene of a theological collapse. It looked like Washington always looks when history has already happened and the microphones arrive afterward. Nameplates, water bottles, staffers, cameras, old men with prepared statements. Henry Waxman, the committee chairman, did not need to shout. The facts in the room were already loud enough. Greenspan sat there as the most famous former central banker in the world, but also as something more fragile, a man being asked whether the intellectual structure of his life had failed in public. He had come with explanations. Securitization had spread risk in ways that were misunderstood. Rating agencies had failed. Risk models had been wrong. All of that was true, and none of it was enough. Waxman pressed him toward the deeper admission. Was he saying that his view of the world, his ideology, had not been right? Greenspan answered with a sentence that should have been carved into the ruins of the era. He had found a flaw. The flaw, as he described it, was in his model of how the world worked, specifically in the belief that banks and financial institutions, acting in their own self-interest, would protect their shareholders and therefore protect themselves. That was the faith. Not that bankers were saints. Greenspan was too intelligent for that. The faith was that self-interest would do what virtue could not. The bankers did not need to be noble. They only needed to be rational. But in 2008, rationality had become collective madness with better vocabulary. This is where the story becomes more unsettling than simple blame. If Greenspan had merely been corrupt, the lesson would be easy. But he was not a cartoon villain. He was not stuffing envelopes with cash in a back room. He was not secretly trying to destroy the American middle class. The more disturbing possibility is that he believed. He believed so deeply that evidence had to become overwhelming before it could become visible. And when it finally became visible, the bill had already moved from Wall Street balance sheets to American kitchens, garages, savings accounts, and unemployment lines. The flaw was not academic. It had addresses. It had moving trucks in driveways. It had parents explaining to children why the house was gone. It had retirement accounts that looked safe until they suddenly looked like numbers falling through a floor. And yet, even in that room, Greenspan did not become a simple penitent. He conceded the flaw, but he also defended much of the structure around it. That matters. People rarely surrender the architecture of their lives all at once. In his own telling, the crisis was a failure of risk management, a failure of models, a failure of institutions to protect their own capital. That explanation is not false, but it is incomplete in the way a map of a crime scene is incomplete if it leaves out who built the building. Because Brooks Liborn had asked about the dark market before it became a public crater. Long-term capital management had shown that elite models could fail spectacularly. Enron had shown that complexity could hide rot. The mortgage market had shown that incentives could corrupt underwriting long before the public understood the word securitization. Greenspan did not lack intelligence. He lacked a certain kind of suspicion. He was suspicious of government failure, suspicious of political meddling, suspicious of bureaucrats who believed they could outperform markets. He was less suspicious of the market's ability to manufacture its own illusions. Part 10. The Defense. After the crash, Greenspan did what powerful men often do when the world they shaped breaks open. He explained. He argued that the crisis had causes larger than the Federal Reserve. He pointed to global savings, mortgage securitization, ratings failures, financial institutions, and the underpricing of risk. There is a kind of defense that does not deny the disaster. It multiplies causes until responsibility becomes atmospheric. Everything contributed. Therefore, no single thing can be blamed too much. This is not always dishonest. Complex events really are complex. But complexity can also become a fog machine for power. Greenspan's defenders had a point when they said monetary policy alone did not write bad mortgages. The Fed did not sit in every broker's office. The Fed did not stamp every rating. The Fed did not structure every CDO. The Fed did not write every credit default swap. The Fed did not create every political incentive around homeownership. But central banks do not need to touch every wire to shape the voltage of the system. Low rates changed the price of credit. The Fed's prestige changed the tone of debate. Greenspan's opposition to derivatives regulation changed what seemed politically possible. His reputation changed who got treated as serious and who got treated as alarmist. Bourne was not defeated only by a policy argument. She was defeated by hierarchy. When Greenspan, Rubin, Summers, and Levitt stood on one side, the imbalance itself became evidence. Who would you believe, Washington implicitly asked, the lone regulator warning about shadows, or the men on the magazine cover saving the world? That is how reputations become policy instruments. By the time people called him Maestro, his authority could do work even when he was not in the room. The idea of Greenspan could silence people. Bourne's warning survived in retrospect because retrospect is generous to warnings. In real time, warnings are inconvenient. They slow deals. They threaten profits. They embarrass people who have built careers on being calm. And in a boom, the person warning about the fire is always accused of hating the warmth. Some of this is fair. It would be intellectually lazy to pretend that one man sat at a desk, lowered a lever, and created the entire housing bubble. Global capital was flooding into American debt. Foreign savings helped keep long-term rates low. Mortgage brokers had their own incentives. Investment banks had their own appetites. Rating agencies had conflicts of interest embedded in the business model. Politicians liked expanding home ownership without asking too many questions about the plumbing underneath it. The Bush administration celebrated the ownership society. Fannie and Freddie had political protection, market power, and balance sheets large enough to worry anyone paying attention. Greenspan did pay attention to that part. He warned that the mortgage giants pose systemic risk. So fairness requires saying this plainly. The crisis was not solely Greenspan's creation. It was built by many hands. Wall Street built it. Washington enabled it. Borrowers participated in it. Rating agencies blessed it. Global investors funded it. But Greenspan gave it something only he could give. He gave it intellectual shelter. For years, when serious people asked whether derivatives needed more oversight, Greenspan's answer carried enormous weight. When markets wanted easy money after shocks, Greenspan's Fed provided it and trusted the system to allocate the results. When mortgage innovation spread, he saw flexibility where others would later see explosives wired into household budgets. When bubbles formed, he doubted the wisdom of pricking them. Each decision had an argument. Each argument had evidence. Each piece could be defended. The danger was the pattern they made together. That pattern was the world Waxman was asking him to confront. Not whether one forecast had been wrong, whether the priest had mistaken the altar for reality. And that is why the Rand years matter. Not because Ayn Rand personally caused the financial crisis. That would be absurd and too neat. They matter because they reveal the emotional structure underneath Greenspan's technical language. The numbers were never only numbers. They rested on a moral assumption about freedom, risk, responsibility, and the dangers of interference. In ordinary times, that assumption could look like wisdom. In crisis, it looked like a locked door with smoke coming out from underneath it. The door had been closed for years. Part 11. The Afterlife of the Maestro. After 2008, Greenspan's reputation did not vanish. Reputations built over decades rarely die in a single hearing. He wrote, gave interviews, defended parts of his record, revised parts of his thinking, and remained, in the strange way Washington works, both discredited and permanently important. That combination is more common than people admit. A person can be wrong about something enormous and still remain useful to the class of people who need the old world explained in familiar language. The Federal Reserve moved on. Bernanke fought the crisis. Janet Yellen inherited the long aftermath. Jerome Powell would later face his own inflation shock. But the Greenspan era did not simply end when Greenspan left the building. It survived as habit. It survived in the expectation that the central bank would rescue markets in crisis. It survived in the reflex of investors listening for the Fed the way earlier generations listened for weather reports before crossing an ocean. Every time markets wobble and traders ask whether the Fed will pivot, pause, cut, rescue, soothe, or signal, they are still speaking a language Greenspan helped make dominant. He lived long enough to see the world change around the institution he had shaped. He lived long enough to become less a daily actor than a symbol. The old man of markets, the maestro whose music had ended with broken instruments on the floor. In June 2026, Alan Greenspan died at the age of 100. The obituaries had to perform the same balancing act the country had never quite resolved. He was the man who helped guide the United States through the 1987 crash, the 1990s expansion, and the early years of globalization. He was also the man whose faith in self-regulating finance became impossible to separate from the worst economic disaster since the Great Depression. Both sentences are true. That is why the story matters. The easiest histories give you monsters and heroes. The more useful ones give you intelligent people whose virtues become dangerous under the right incentives. Greenspan's virtue was certainty. He could take a noisy world and make it sound legible. He could speak calmly while markets shook. He could sit before Congress and admit a flaw without fully dismantling the faith that produced it. That is the final shape of the tragedy. A young man enters a circle that teaches him the market is not just useful, but morally superior. The man enters the central bank and spends nearly 2 decades translating that instinct into policy caution, deregulation, and faith in sophisticated self-interest. A warning arrives. It is treated as a threat. A hedge fund nearly breaks the system. The lesson is softened. A law leaves the dark market dark. Cheap money finds houses. Houses become securities. Securities become bets. Bets become a system no one fully sees. Then men walk out with cardboard boxes. And the old man says he found a flaw. Part 12. The room after the confession. Imagine the hearing room after everyone left. The cameras packed away, the staffers gone, the water glasses half empty, the microphones no longer glowing red. That is where the real question remains. What does a society do after the most trusted economic mind of an era says the model was flawed? It can punish a few people. It can pass reforms. It can rename departments, thicken rule books, and promise that next time the alarms will ring louder. And some of that matters. Dodd-Frank mattered. Capital rules mattered. Derivatives clearing reforms mattered. But before reform came rescue. The Troubled Asset Relief Program, TARP, put the federal government openly behind a financial system that had spent years celebrating the discipline of markets. The language changed almost overnight. The same world that had praised market discipline now warned that too much discipline could destroy the economy. To ordinary Americans, this looked like a moral inversion. Homeowners were told they had borrowed irresponsibly. Banks were told they were systemically important. Families who missed payments faced foreclosure. Institutions that mispriced entire markets received emergency facilities, guarantees, capital injections, and acronyms. One door said moral hazard, the other said stability. The anger that followed did not come from nowhere. It came from watching a system discover compassion at the exact altitude where banks lived. By 2011, people were camping near Wall Street, speaking a language of the 1% and the 99% that would have sounded strange in the triumphant 1990s. On the right, the bailouts fed a different fury, suspicion of government, elites, central banks, and backroom rescues. The crisis did not only damage balance sheets, it damaged legitimacy. And legitimacy is harder to recapitalize than a bank. This is another reason Greenspan's Flaw mattered. It was not a private intellectual correction. It became part of a broader public suspicion that the people who had claimed expertise had not merely failed to prevent disaster. They had designed a world where disaster traveled downward. Dodd-Frank tried to answer some of this. It created new oversight, new rules, new mechanisms for derivatives, consumer protection, and systemic risk. The Consumer Financial Protection Bureau emerged from the idea that ordinary borrowers had been left too exposed to contracts they could not realistically decode. Derivatives that had once lived in the shadows were pushed toward clearing and reporting. The government tried to map systemic risk before it became an emergency. In other words, after the crash, Washington tried to build some of the sightlines Brooksley Born had been punished for wanting earlier. History has a way of apologizing to people in footnotes after ignoring them in meetings. But regulation, once passed, becomes the next battlefield. Banks adapt. Lobbyists return. Memories fade. Complexity rebuilds itself in the spaces between old rules. That is not cynicism. It is the maintenance schedule of power. Meanwhile, the Fed entered a new era of intervention. Emergency lending, quantitative easing, forward guidance, balance sheet expansion. Bernanke, the scholar of the Great Depression, acted with a force Greenspan had rarely needed to use. The central bank became larger in the public imagination, not smaller. Here's the paradox. Greenspan believed deeply in the power of markets, but the world after Greenspan made the central bank even more central. The high priest of markets helped create a world where markets waited for priests. But reforms do not automatically kill the belief system that made them necessary. Often they repair the machine just enough for the machine to keep its place in the room. The Federal Reserve today is not Greenspan's Fed. The world has changed, the models have changed, the regulatory landscape has changed. But the emotional structure remains familiar. Markets still wait for signals from central bankers. You could see it again in March 2020, when a virus did what wars, terrorist attacks, and banking panics had done before. It made markets look suddenly primitive. Prices fell with the violence of people discovering that liquidity is not a natural condition. It is a social agreement, and social agreements can break very quickly when everyone reaches for the exit at once. Jerome Powell's Fed responded with emergency force. Rates to near zero, vast asset purchases, liquidity facilities, promises that the central bank would do what it took to keep markets functioning. This was not Greenspan's policy in a narrow sense. The scale was larger, the tools different, the crisis medical before it was financial. But emotionally, the old pattern was recognizable. Markets panicked. The Fed arrived. The floor appeared. Investors learned again that the central bank was not merely a referee. In the deepest stress, It could become the field, the weather, and the emergency generator all at once. Then came another strange consequence. With rates near zero and stimulus moving through the economy, risk appetites changed again. Meme stocks exploded. Crypto soared. Startups raised money at valuations that seemed to assume the future had been permanently discounted to zero. The details were new, but the psychology was old. Cheap money does not tell people what to buy. It changes what people are willing to believe. Then inflation returned, and the old Volcker ghost walked back into the room. The Fed raised rates at a speed that reminded markets of something they had spent years forgetting. Money can become expensive again. Stocks fell. Bonds fell. The old assumptions cracked. And once again the central question became not only what the economy was doing, but what the Fed would tolerate. In 2023, Silicon Valley Bank failed after a classic mismatch met a modern bank run. Depositors did not need to stand for days outside a branch the way their grandparents might have done. They could move money with phones, group chats, and panic accelerated by networks. Again, authorities stepped in to contain contagion. The instruments had changed. The emotional structure had not. This is why Greenspan's story still matters after his chairmanship, after the crash, even after his death. He did not invent every rescue. He did not create every bubble. He did not write every line of the modern financial script. But he helped establish the grammar. The grammar says that markets are powerful information machines until they break. When they break, the central bank must act. When the central bank acts, markets learn how far panic can go before help arrives. And once markets learn that, the boundary itself becomes part of future risk-taking. That is not a conspiracy. It is worse, in a way. It is an incentive structure doing exactly what incentive structures do. Greenspan's tragedy is that he understood incentives brilliantly when they came from government. He was less willing to believe that private markets could build incentive structures just as distorting, just as evasive, and just as detached from ordinary accountability. A broker paid to originate will originate. A bank paid to securitize will securitize. A rating agency paid by issuers will face pressure to please issuers. A fund rewarded for leverage will find arguments for leverage. An insurer paid to write protection may keep writing protection long after the word protection has become almost comic. Markets do not abolish human weakness. They organize it. That is the sentence Greenspan never quite seemed able to say. When he died in 2026 at 100, the obituaries reached for balance because balance was the only honest form left. They called him brilliant. They called him consequential. They noted the long prosperity of the 1990s, the global respect, the calm through earlier storms. And then they had to turn to 2008. No life that passes through that hearing can be written as simple triumph. But no honest account can make him small either. He was too central to be dismissed, and too wrong in the end to be safely admired. That is the story's uneasy power. A boy who loved structure became a man who trusted structure too much. He believed systems could discipline themselves if the incentives were aligned. Then he watched a system reward people for hiding risk until risk became the system. Investors still search statements for hints, commas, shifts in tone. A word changed from patient to vigilant or restrictive to neutral. In that sense, Greenspan did not merely run the Fed. He helped teach the world how to listen to it. That may be his most durable legacy. Not one rate cut, not one speech, not one hearing. The transformation of central banking into a kind of secular priesthood where unelected officials speak in careful language and entire markets rearrange themselves around the interpretation. There is a bitter irony in that. The man shaped by a philosophy of markets and individual judgment became the voice markets waited on like dependent children. The high priest of self-reliance became the reassurance mechanism. And when the reassurance failed, ordinary people paid for truths they had never been allowed to inspect. Go back one last time to the boxes outside Lehman. They look small against the glass towers. Cardboard, tape, paper, a few personal objects from desks where the future had seemed only days earlier professionally managed. Go back to the old man at the table, the careful voice, the admission. He found a flaw. But the flaw was never only his. It belonged to an era that wanted markets to be smarter than politics, cleaner than regulation, more honest than people, and somehow immune to the incentives of the people inside them. It belonged to the magazine covers, the reverent profiles, the senators who deferred, the bankers who profited, the economists who modeled, and the voters who were told that the serious people had it under control. It belonged, too, to the warnings that were heard and then contained. And it belonged to a quiet boy from Washington Heights who learned early that the world could be made less frightening if you could turn it into numbers. He spent a century turning noise into structure, music into ledgers, ledgers into forecasts, forecasts into authority. For a long time, that authority looked like wisdom. Then the bill arrived. Part 13. The story they still tell themselves. Here is the part that makes this story more than a post-mortem. After 2008, almost nobody in power said the old religion had been false from the beginning. They said it had been taken too far. They said supervision had been too light. They said risk models had been too optimistic. They said the machine needed guardrails. But they did not say the machine's deepest promise had failed. Because to say that would have meant admitting something more frightening than a bad forecast. It would have meant admitting that for a generation, the most powerful people in American finance had confused sophistication with wisdom. They saw thick documents and assumed discipline. They saw equations and assumed reality had been captured. They saw ratings and assumed judgment had been applied. They saw Greenspan's calm and assumed the adult in the room had already looked into the darkness. But the darkness was not hidden because it was impossible to see. Brooksley Born saw part of it. Homeowners saw part of it when the payment reset and the house stopped feeling like an asset and started feeling like a trap. Short sellers saw part of it when the loans inside the bonds looked nothing like the ratings printed on top. Even some insiders saw part of it, enough to whisper, enough to hedge, enough to get nervous, but not enough to stop the fees. That is the moral architecture of the crisis. Greenspan did not need to be corrupt for the system to become dangerous. He only needed to believe, sincerely and powerfully, that markets would correct what government could only distort. He only needed the old Randian suspicion of state power to survive long enough inside a job built almost entirely from state power. He only needed to mistake restraint for neutrality, because doing nothing is not always neutral. When brokers are paid to push loans, doing nothing helps the brokers. When banks are paid to package loans, doing nothing helps the packagers. When derivatives move into shadows, doing nothing helps the people already comfortable in the dark. This is why the word deregulation is almost too clean. It sounds like removing clutter. It sounds like freeing energy. It sounds, in the language of the era, like letting innovation breathe. But in practice, it often meant moving risk away from the places where voters, supervisors, and even executives could clearly see it. It meant taking a loan made to one family in one neighborhood by one broker and sending it through so many hands that responsibility became mathematically diluted. By the time the family lost the house, the people who had made money from the transaction could claim the damage belonged to someone else's spreadsheet. That was the true genius of the machine. It did not eliminate guilt. It distributed guilt so widely that almost nobody had to feel the whole weight of it. And then, in 2008, the weight returned to the room. Waxman was not asking a purely technical question. He was asking whether an entire worldview had just been cross-examined by reality. That is why the answer still echoes. Not because it was dramatic. It was not. Greenspan did not break down. He did not offer a grand apology. He spoke like a man still trying to place the failure inside a framework that could survive it. Outside that framework were the people who did not need a model to know what had happened. They knew it in unemployment lines. They knew it in moving boxes stacked in living rooms. They knew it in retirement accounts that suddenly looked like crime scenes printed on paper. They knew it in the quiet humiliation of telling children that the family had to move. That is the part of financial history that gets lost when a crisis becomes a chart. Charts are necessary. They show scale. They show contagion. They show the speed of collapse. But they do not show the moment a person realizes that the people who promised discipline had been gambling with distance. Greenspan titled his memoir The Age of Turbulence. It was a good title, maybe better than he intended, because turbulence is what happens when forces that look smooth from far away suddenly reveal the violence inside them. The 1990s looked smooth from far away. The housing boom looked smooth from far away. The derivative books looked smooth from far away. Even the myth of the Maestro looked smooth from far away. Then the surface cracked, and the turbulence had been there all along. This is the final inversion. The young man who learned to distrust collective planning became the symbol of an era that outsourced collective fate to invisible mechanisms. Millions of people were told that no single planner could know enough to guide the economy. Then millions of people watched markets hang on the decisions of a small committee in Washington. They were told markets were too complex for politics. Then, when those markets failed, politics had to rescue them with money taken in the name of the public. No wonder the anger scattered in opposite directions. Some people saw Wall Street protected from consequences. Others saw Washington expanding after Washington had failed. Both were looking at the same wound from different sides. And in the middle of that wound stood the question Greenspan left behind. What happens when the people most trusted to understand markets are also the people most invested in believing markets can understand themselves? The answer is not that expertise is useless. The answer is that expertise becomes dangerous when it forgets what it cannot see. The risk officer could see a model. The family could see a payment. The banker could see a fee. The rating analyst could see a category. Greenspan could see a system that, in his mind, still carried the discipline of self-interest. But nobody with enough authority was forced to see the whole thing at once. That is why the collapse felt sudden to people who had been living inside it for years. The warning signs were not absent. They were distributed. One in a contract, one in a hearing, one in a neighborhood, one in a hedge fund, one in a spreadsheet that looked too profitable to question. By the time they gathered into one visible shape, the man who had trusted the system was sitting under oath explaining the flaw. And somewhere inside the architecture of modern finance, the old belief still hums. That markets know best. That serious people can manage the aftermath. that the next rescue will be cleaner than the last one. Alan Greenspan is gone now. The Flaw is not. The most dangerous stories are rarely the ones where nobody saw the warning. They are the ones where the warning arrived and the people in charge decided the system was too elegant to be wrong. If this is the kind of history you want to keep finding, the kind hidden inside institutions, markets, and men who sounded reasonable while the ground shifted underneath them, subscribe. See you at the next one.